Welcome back. Our first guest in this hour uses artificial intelligence models to help create investment portfolios. Those models at the end of last year predicted a 10% stock market pullback in the second half of 2025, driven by tariffs and potentially higher inflation. Let's find out more by talking to Doug Clinton. He's founder and chief executive officer of Intelligent Alpha. Doug, thanks a lot for joining us. I'm seeing that your AI models at the end of last year, as we just told viewers, were predicting a 10% pullback in the back half of 2025. Now, of course, we are seeing a pullback has taken place during the second half of this month. The S&P 500 is down about 4.5% over that period of time. And what's getting a lot of attention in the marketplace today is that the Trump rally, the surge in the S&P 500 that we saw immediately after he was elected on November the 1st has almost entirely melted away. So I guess my first question is, has the pullback come early?
Well, I think, Paul, there's always a factor with markets where we get reversions to the mean. And maybe that's a little bit with what we're dealing right now. In terms of our models, I think our models are sort of sticking with the prediction that this might be a bit of a head fake in terms of a full correction. And that correction, the models still think probably comes a little bit later this year. But ultimately, I think when you talk about the Trump trade, the way that we ended last year, really the last 2 years in markets, we've been sort of spoiled. We really haven't had meaningful pullbacks to speak of. And so I think every time we get one of these 4 or 5% moves, it actually feels probably a lot worse than it really is when you zoom out and look at the long term of the markets.
What are your models assuming about tariffs? Are they assuming that very steep tariffs, i.e. 25% or so, are put in place and last for a meaningful length of time?
Our models, I think, are trying to look past the tariff issue to some degree. It's hard to look past it fully because they're probably one of the most important vectors in the markets trying to figure out where we go from here. But if you look at what the exposures are that our models have sort of identified where they think there's opportunity, one of the opportunities is in China, where obviously that's one of the prime tariff, I think, territories. We just learned yesterday that President Trump will be assigning an additional 10% to Chinese products. So I think that our models are trying to figure out, okay, look, even if we have this tariff issue with China, EPS in Chinese stocks, large cap stocks, is still in kind of the low teens. And so it feels like there's a little bit of support in terms of valuation, even if we get some impact in the Chinese economy from the tariffs in the US.
So the models, in terms of investing opportunities in 2025, the models like China, is that correct?
It's correct. It's sort of one of the major 6 themes right now that our models have identified and want to be exposed to. AI, energy are 2 of the other big themes, but China has been a theme that AI has been on since about September of last year.
What do the models say about the energy market? And by energy, what exactly do we mean? Oil and gas?
So at the beginning of the year, AI was more attracted, I would say, to alternative energy sources. So things like GE Vernova, natural gas, products like that, and driven by, I think, some of the AI demand for that energy source. More recently, actually, the models have shifted a little bit more, and they've gone to traditional oil and gas providers. ConocoPhillips COP is now one of the top energy holdings in our Livermore ETF, LIVR, where we expose these themes in an investable product.
And what about uranium in terms of energy, uranium and nuclear energy?
So nuclear actually hasn't been something that the models have pulled in to any major degree. It's had holdings in Cameco in the past. In our last portfolio review, where we have our AI models go through everything that's in the current portfolio, pull things out and put new ideas in, Cameco isn't one that stayed in. So it's kind of moved away, I think, from the nuclear theme, even though long term it does seem like it makes sense.
And as you've noted, your artificial intelligence models like artificial intelligence as an investing theme in 2025. Tell us what the models show there.
Yeah, it likes it, Paul, and it hasn't been right about itself. Unfortunately, AI has been sort of a tough trade since the beginning of the year. And obviously, NVIDIA earlier this week, which is still one of the top picks from our AI models to the AI theme, did not add to the, I think, fuel that we hoped it would. which was a little surprising personally. I mean, just following the earnings, looking at what NVIDIA reported, I actually thought the quarter was pretty good, and the guidance was a little bit better than what they had guided to the prior quarter. And so I think the reaction was really just people maybe getting exhausted with the AI trade. Our models still believe that there's a lot of upside in AI, that there's still a lot of infrastructure to be built. But I think the emotions in the market right now are probably going to trump fundamentals for at least a little bit.
And you hold NVIDIA stock as your largest artificial intelligence position, correct? In your model portfolios or your client portfolios?
That's correct. NVIDIA is the top AI holding. And one other holding actually that our models have just pulled in that I think is a little bit interesting from the software side is actually Adobe, a company that the stock hasn't really performed very well the last year. They haven't really had a great AI story. They've been building it into their products, obviously. But our models think that Adobe here might be one that starts to pick up in terms of their AI benefits throughout the year.
So just to resume where we began our conversation, which is the forecast of a meaningful market downward correction in late 2025, what sectors of the U.S. stock market do the AI models least prefer? Where does the model see the weakness coming from?
It's certainly been avoiding consumer discretionary. Housing sectors like that have been things that it has avoided in its portfolio and things that it's sort of maintained. We talked about energy, and another area that the models have been more excited about more recently have been things like copper mining, rare earth minerals. We're hearing obviously a lot more about that coming out of Ukraine, but that may be another good place to be if we do have an economic slowdown later this year.
Doug,